Have you been hearing about mutual funds and thinking about investing in it, but you're not sure if it's the right decision? So now you are confused. You are asking yourself if your money will be actually safe or if you can lose money you invested. Questions like which mutual fund you should choose, how much you need to start, and how do you know whether a mutual fund is actually performing well? If these are the questions on your mind, then stay with me to the end of this video. I will answer every one of them in simple English. By the time you finish watching this video, you will understand how mutual fund works, the different types available in Nigeria, the risks you need to know, how to calculate your returns, and how to choose the right mutual fund based on your financial goals. My goal for this video isn't just to tell you where to invest your money. My goal is to help you understand why you are investing there so you can make better financial decisions with confidence. If that sounds like something you will enjoy, please take just a second to like this video. It really helps the video reach more people who are trying to grow their money the right way. And if this is your first time on the channel, you're welcome. My name is Helen. On this channel, we talk about investing, about saving money and building wealth in a way that is practical and easy to understand. So make sure you subscribe and turn on notifications so you don't miss any of our future videos. Now let's get started. But before you invest a single naira, you need to understand what exactly is a mutual fund, because if you don't understand what happens to your money after you invest, you may panic when you shouldn't, or worse still, you may invest in the wrong mutual fund. So if mutual fund is simply a way for many people to invest their money together, let me explain it this way. If you and 10 of your friends decide that each of you will contribute 10,000 naira each, now together you have raised about 110,000. Now imagine instead of just 11 people contributing, 10,000 people decide to contribute towards a particular goal. Some people could only afford maybe 5,000, some contribute, 50,000, others put in hundreds of thousands or even millions of naira. All that money is now combined into one large investment pool to achieve a purpose. Now here's the interesting part. That money doesn't just sit in an account. It is invested, not by you, not by me, but by professionals whose full-time job is to manage investment. These professionals are called fund managers, and their job is to look for investment opportunities that match the objective of the mutual fund. So instead of you trying to figure out whether to buy treasury bills, government bonds, or shares in different companies, the fund managers does all that work on your behalf, even if you don't know how to analyze the stock market. Now, this is another important question people ask. How do you know the company managing your money is genuine? After all, we hear, stories of investment scams all the time. The good news is that mutual funds in Nigeria are managed by licensed fund managers who are regulated by Securities and Exchange Commission, known as the SEC. That means they must follow strict rules and regulation before they can collect money from investors. But here's something you need to remember. Just because two companies are licensed doesn't mean they will perform exactly the same way. Some fund managers have consistently delivered better long-term results than others. That's why later in this video, I will show you what you should check before choosing any mutual fund. So I will advise you to watch the video till the end. Now that you understand what a mutual fund is, let's talk about different types, because this is where some people make expensive mistakes. Someone tells them, I'm earning 20% from my mutual fund, and immediately they rush to invest in the same fund. And that's not bad. But here is the thing. The best mutual fund for your friend may not be the best mutual fund for you, because every mutual fund has a different objective. Some are designed to protect your money. Some are designed to, grow your money over a long period of time. Some aim to give you a balance between growth and stability. So before you invest, ask yourself what you want the money you are investing to do for you. Like, do you want to keep it safe for a short period? Are you building wealth over the next 10 or 20 years? Or are you just looking for a balance between safety and growth? So once you can answer that question, choosing the right mutual fund becomes much easier for you. Now let's look at the main types. Let's start with the one that most people hear about first, which is the money market fund. If someone tells you, I just want somewhere to keep my money while earning better returns than regular savings account, they are probably talking about a money market fund. This type of mutual fund invests in low risk investments such as the treasury bills, commercial papers, bankers' acceptance, fixed deposits, and other short-term government and corporate securities. And all these investments are more stable than shares. The money market funds are, one of the lower risk type of mutual funds, but don't misunderstand low risk for no risk. Every investment carries some, level of risk. The difference is that the risk here is usually much more lower than investing in the stock market. So if your goal is to preserve your capital while earning steady returns, a money market fund could be a good option for you. For example, if you're saving money you will need maybe in the next 6 months to 1 year. Okay, now let's move to the exact opposite end of the spectrum, which leads us to type 2, an equity mutual fund. Instead of investing mainly in treasury bills or government securities, an equity fund invests a large portion of its money in shares of companies. That means when the stock market performs well, the value of the fund can increase significantly. But when the stock market goes through a difficult period, the value of your investment can also fall. This type of investment is a high risk investment compared to the money market. Now, before that scares you, let me explain something. Higher risk doesn't automatically mean it's a bad investment though. It just means you should invest with the right expectations. So if you are investing money you know you won't need for several years, an equity fund may give your money more opportunity to grow very, very well over the long term. The problem comes only when you invest money you will need in 6 months into an equity fund and then the market drops just when it is needed. You may be forced to withdraw at a loss because you need the money immediately. I hope you get that. So your investment period matters just as much as the fund you choose. Next is the bond fund. You can think of this as sitting somewhere between a money market fund and an equity fund. This type invest mainly in government bonds and corporate bonds, and because of this they generally carry moderate risk, and they also tend to offer moderate returns. They are not usually as stable as money market funds, but they are often less volatile than equity funds. So if you're comfortable taking a little more risk than a money market fund, but don't want the ups and downs that often comes with stocks, then you can go for this. And finally, we have the balanced fund. Sometimes it is called a mixed fund. Just as the name suggests, it combines different types of investments. So instead of putting all your money into one asset class, the fund manager spreads it across stocks, across bonds, and money market instruments. The goal is very, very simple. Okay, so when one investment isn't doing well, another may help reduce the impact. It's a way of balancing risk and potential returns at the same time. And many people like balanced funds because they don't have to choose between only safety or only growth. Now, you may be thinking, Ellen, just tell me the best one. And I wish it were, that simple. But there isn't one mutual fund that is best for everyone, as the right choice usually depends on you. You have to ask yourself these questions. Why am I investing this money? Is it for school fees next year? Is it for buying land in 5 years, for retirement, or building long-term wealth? The next question you should ask yourself is, when will I need this money? If you will need it very soon, you probably don't want to expose it to an unnecessary market fluctuations. So if you won't touch it for many years, then you can afford to be more patient. Finally, ask yourself, how comfortable am I with seeing my investment go up and down, because some people panic the moment they see, a temporary loss. Knowing yourself is just as important as knowing the investment you are getting into. So if you are still with me, let me know by hitting the like button. It tells me you are enjoying the video, and it helps the YouTube algorithm recommend this content to more people who want to make smarter financial decisions. And if you haven't subscribed yet, this is a great time to do so, because we have many more videos on investing, on ETFs, on stocks, and wealth building strategies still coming up. Now that you understand the different types of mutual funds, let's answer probably the biggest question on your mind. If I invest my money now in mutual fund, is my capital guaranteed, or better still, can I lose my money? My honest answer is yes, but it depends on the type of mutual fund you invest in. I know that may not be the answer you were expecting from me, but I rather tell you the truth than make promises that are not true. Okay? Now let me break it down. If you invest in a money market fund, the chances of losing your money are generally much lower, because most money market funds invest in things like treasury bills, government securities, commercial papers, and other short-term fixed income investments. But no mutual fund in Nigeria can honestly promise you 100% guaranteed result with zero risk. If anyone tells you that, be very careful, because every investment carries some level of risk. The difference is simply how much risk you are taking. Now, suppose you invest in an equity fund. Remember, an equity fund invests mainly in shares of companies listed on the Nigerian exchange. And what happens to share prices? They don't move in one direction. Some years the market performs exceptionally well, and other years it struggles. So the value of your equity fund will automatically also rise and fall. Okay, so let's discuss the main risk involved. Don't worry, I'm just going to explain them in simple language. Number one is market risk, and this mainly affects the equity fund. If the stock market falls, the value of your investment may also fall, and that's completely normal. Markets go up and down every single day. The important thing is just to understand that short-term fluctuations are part of long-term investing. So number two is the interest rate risk. This mostly affect bond funds, actually. So when interest rates change, the prices of existing bonds can also change, and that may affect the performance of bond funds. You don't need to become an economist to understand this. Just know that changes in interest rates can influence the returns you earn on, from bonds investments. Number three is inflation risk. Now, this one is very important, especially here in Nigeria. Let's say your mutual fund gives you a return of 80% in 1 year. That sounds great, right? But what if the inflation during that same period is 25%? Although your money has increased in Naira terms, the cost of goods and services has also increased even faster. In other words, your money has lost purchasing power, okay? This is why, as smart investor, don't just ask how much return did I make. Also check if your investment grew faster than inflation, because that's what really increases your wealth over time. The risk number 4 you should look into is the fund manager risk. This is another risk many people don't think about. Remember, your money is being managed by professionals, and the quality of their decisions matters a lot. A skilled fund manager with a strong investment process may consistently perform well over many years, while another fund manager may make poor investment decisions that affect the performance of your fund. And that's why you shouldn't choose a mutual fund simply because someone recommended it to you. Always take a time to look at its track record. How has it performed over the last 1 year, over the last 3 years, over the last 5 years? Because while past performance doesn't guarantee future results, it can give you an idea of how the fund has been managed over the time. So if you're finding this video helpful, once again, I'd really appreciate it if you could hit the like button. It may seem like a small thing to do, but it helps YouTube recommend this video to more people who are trying to learn how to invest wisely. And if you are enjoying this kind of practical financial education, make sure you subscribe, because there are more videos like this coming every week. Okay, now back to our discussion. How do you know whether a mutual fund is actually performing well? Maybe you've had someone say, this fund returned 80% last year, or that one has a 22% year-to-date return. What does all that mean? And more importantly, how do you know whether these numbers are actually good for you? Now, let's start with something very simple. Imagine you invest 100,000 in a mutual fund, and 1 year later, your investment is now worth 115,000. How much profit have you made? That's 15,000. So to calculate your percentage return, simply divide your profit by the amount you invested and multiply by 100. In this example, that will be 15,000 divided by 100,000 times 100, and that gives you 15%. So your investment earned a 15% annual return. It's really that simple. Okay? Now, what's year to date? Simply put, year to date means how a mutual fund performed from the beginning of the current year until today. For example, if today is August and the fund has grown by 12% since January, then its year to date return is now 12%. It's a useful information, but it doesn't tell you the whole story. A fund may have an excellent year to date performance simply because the market has been strong over the past few months. But that doesn't necessarily mean it has performed well over the long term. So don't make your investment decisions based on YTD alone. Check the 3-year and 5-year performances. Personally, if I am considering a mutual fund, I'm far more interested in how it has performed over 3 years or even 5 years, because long-term performances tells you more about the quality of the fund manager than short-term performances. Any fund can have one fantastic year, but can it perform consistently over several years? That's the real question. So what is the best mutual fund in Nigeria? Now, I know some of you have been waiting for this part, but honestly, there isn't one fund that is best for everyone. The best mutual fund depends mainly on your goals. Let me explain. If your priority is protecting your money while earning steady returns, you may prefer a money market fund. If your goal is building long-term wealth and you're comfortable with some ups and downs along the way, an equity fund may be a better fit for you. If you want something in between, a bond fund or a balanced fund may suit you. So instead of asking what's the best mutual fund in Nigeria, ask yourself, what's the best mutual fund for what I want to achieve? That one question can save you from making the wrong investment decision. So how much do you need to start? Many mutual funds in Nigeria allow you to start with as little as 5,000 naira. Some may require maybe 10,000, meaning the amount many people spend on fast food or subscriptions or impulse purchases in a week could be enough to start investing. So if you've been waiting until you have millions before you begin, you may be waiting longer than you need to. The important thing isn't how much you start with. The most important thing is that you start. Just start first. And this brings me to one of the biggest lessons in investing. Many people think wealth is built by investing huge amounts of money at once. No, that's only part of the story. The other part is time. And time allows your returns to generate more returns. That's simply the power of compounding. It's one of the biggest reasons financial experts always say start as early as you can. You don't have to start big. You just have to start. Now you know how to judge a mutual fund, how much you need to start, and why consistency is more important than trying to invest a huge amount once. But there is another important question. How do you actually invest in a mutual fund in Nigeria? Can you do everything from your phone? Do you have to visit a bank? What documents do you need? Now let's make this very, very practical. You've decided that you want to invest, right? What exactly should you do? See, in most cases, you don't need to visit a bank or the office of the fund manager. You can complete almost everything right from your mobile phone. The first thing you need to do is to choose a fund manager that is licensed by the Securities and Exchange Commission, known as SEC. Don't invest with anybody because they promise high returns. So review the different types of mutual funds they offer and compare their long-term performances. Once you've chosen a fund manager, you will need to open an account. This is usually done online. You will be asked to complete a Know Your Customer form, which is called KYC. And depending on the company, they will request information such as your name, your full name, your phone number, your email address, your bank verification number, which is your BVN, a means of identification, passport photograph, your signature, your bank account details. The purpose of all of this process is to verify your identity and protect your investment. Once your details have been verified, your account is ready for use. Verification can take anywhere from 24 to 48 hours, although it may vary. The next step is simply to transfer into your investment account. Whether you are starting with 5,000 naira or 10,000 or even more, the process is usually very straightforward. Most fund managers allow you to make additional investments whenever you want, and that's something I encourage you to do. So instead of waiting until you have a huge amount of money, develop the habit of investing consistently, even if it's once every month. Consistency often offers more than trying to invest a large amount only once. I hope you understand. Before you click away from this video, let me quickly share 5 mistakes I don't want you to make. Mistake number 1 is investing without understanding the type of mutual fund you are buying. And mistake number 2 is looking only at the year's returns. A fund may have an excellent year, but how has it performed over 3 years, over 5 years? Consistency matters in this. Mistake number 3 is ignoring management fees. Every fund manager charges fees for managing the fund, which are around 1% to 2% a year. Some may be higher. These fees affect, your overall return, so don't ignore them, please. Mistake number 4 you should avoid is investing your emergency fund in the wrong place. This is a mistake many people make. If this is money you may need at any time, perhaps for medical emergencies, for rent, or unexpected expenses, you don't want to expose it to unnecessary market volatility. Emergency funds should generally be kept in investments that are easy to access and relatively stable, such as a money market fund and other suitable short-term options. Your emergency fund has just one job, which is to be available to you whenever you need it. Mistake number 5 is expecting to become rich overnight. Investing isn't gambling. It's not a get-rich-quick scheme. It's a long-term wealth-building strategy, and the people who benefit the most from investing are usually those who stay consistent and remain patient, and also give their investment time to grow. If you found this video helpful, please give it a thumbs up. It really helps this channel grow and lets YouTube know that more people should see this video. If you're not yet part of our community, click the subscribe button and turn on notifications, because every week I share practical videos to help you invest wisely, save intentionally, and build lasting wealth. Now, I'd love to hear from you. Have you invested in a mutual fund before, or are you planning to start after watching this video? Share your thoughts in the comments below. I'd love to read them and answer your questions. Thank you so much for watching with me today, and I'll see you in the next video. God bless you.